In this video, I want to talk about how I built an unbreakable portfolio that beats 90% of investors. I've been investing for almost a decade and my performance has outperformed almost everybody. So in this video, I will give you some tips so you can copy my portfolio. You can copy my decisions, copy my strategy so you can outperform the market. Welcome. In case this is your first video from this channel, my name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. Thanks to these tips I want to show you today. So let's start with the first one. The principle number one is to only invest in businesses, in companies, in stocks you understand deeply. Confusion leads to mistake. Clarity leads to conviction, and conviction builds wealth. This is a principle that is very important. This is why I'm putting it first. In the universe of companies, you have 50,000 companies, right? You have 50,000 stocks that you can invest in the stock market. Out of 50,000 companies, how many do you understand? How many of them do you understand? You will not understand 50,000 stocks, I guarantee that. Maybe you will understand 1,000, maybe less, maybe 500. Out of this list of 500, what do you really understand? Maybe 200. Okay, fair enough. You go from 50,000 to 200. Out of this list of 200, what are the best businesses you can find? Out of the list of 200, you will maybe select 50. Out of these 50 companies, 50 stocks, what is trading at a reasonable valuation, or what is cheap? And from 50, you fall down to 10. You start from the universe of stocks, your investable universe of 50,000 companies, and you have this big threshold, and you just reduce to 10 companies. This is how I pick my stocks. This is how I pick my quality companies, and I buy them when they trade at a discount, and I hold for very long term. Understanding what you own is very important, because when you will have panic in the market, a market crash, you will know how to react. You will know how your stock, your company, will be impacted by this crash. For example, in 2025, you had a new wave of tariff. If you really know the stocks you own, the companies you own, you will know if this company will be impacted by tariffs. Okay? You will know if the impact is great or not at all. For example, if you are in the footwear equipment, furniture equipment, home furniture, for example, that are imported from Asia, maybe you will have some impact. But if you are meta platforms, Facebook, Instagram, WhatsApp, almost zero impact, right? Zero, it will not affect you much. And a company that is only operating in the US, importing from the US, manufacturing from the US, and having customers in the US will not have such impacts on revenue, on profitability, margin, etc. So the first principle is only invest in businesses you understand deeply. For all the companies I have in my portfolio, I can pitch the investment thesis in 2 minutes. In simple words, you will understand everything. I can go in depth and analyze the business thoroughly and explain thoroughly what is happening. I know all the risks, all the growth opportunities. I know the management team. I know how it works. I know the industry very well. This will dismiss 99% of the stocks you will find in the market. The goal is not to analyze everything. The goal is not to sound smart. The goal is to invest in the top 1% best companies you can find and hold for dear life. This is how I generated more than 20% per year in the stock market. Not by wasting my time studying bad businesses. I only want to keep the best ones and analyze them and invest in them when they are trading at a reasonable valuation. Second principle is to prioritize balance sheets over growth stories. I see many times this mistake now that we are in this environment of AI growth stories. People want to invest in the next big thing. People want to invest in a company that is growing their revenue very fast and that is expected to grow their revenue very fast in the future. But sometimes the growth falters. Sometimes the growth plummets because of regulation, competition, anything can happen, right? And these companies are often filled with debt. So if you have a growth profile that is topping, that is now declining, if you don't have a lot of cash flows, if you are filled with debt, you increase your chance of going bankrupt. And as stock pickers, we want to avoid companies that will go bankrupt, right? So you want to minimize your risk. And how do you minimize your risk? You prioritize balance sheets over growth stories. You want a business that is rock solid. This is what I want. I want a business that is rock solid, filled with cash, that will not deal with debt, that is providing cash flows every year, generating strong profits every year. Very easy. So in case we have a crash like 2008, I know with good certainty that this business will, one, survive, and two, they have the flexibility to take advantage of this volatility. When everybody is panicking, my business will thrive because it has the cash, it's agile, flexible, they can make an acquisition, they can do some buybacks, they can do whatever they want. This flexibility of choice is the reason why these businesses are better positioned, just in case we have a market drawdown, a crash. A strong company survives a storm. It survives storms, exactly. A weak one collapses when the winds change. Second tip on this principle is sometimes you will find companies that are sexy. I'm thinking of the renewable energy right now. So companies, industries that rely on subsidies from the government. In case we have a crash, in case the regulation changes, the subsidies for the government will be reduced, will be stopped. Will the company survive? I've seen countless examples of companies that were growing the revenue rapidly because of subsidies from the government. And when the subsidies stop, boom, complete collapse, complete bankruptcy, zero revenue growth, zero earnings, zero cash flows. These businesses die. You want to avoid these kind of businesses at all costs. Businesses that rely heavily on subsidies to survive. I'm European, so you can find plenty of European names linked to the energy in particular that relied on subsidies. And then the government is struggling, they cut their spending budget, they stop the subsidies, and boom, these stocks collapse completely, minus 80%. I've seen countless examples of this. Okay? So this was for the second principle. I only pick companies that are strong financially, that will survive in case we have a crash. Now we are living in a booming economy time. It's a good time to invest in stocks. Stocks are going up, very happy, very well. But what if we have a crash? You always want to be prepared in case we have a crash in 2026, for example. What if we have a major crash, minus 30%, minus 40% in stocks? The economy falls down. Turns out that we have a trade war with China. All the scenarios are possible. What if this happens? Is your company ready to face uncertainty? If customers back off, if the costs increase? And my portfolio is built with companies that can survive. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Next point, principle number 3. Concentrate your best ideas. Don't water them down. The best portfolios are built on a few outstanding decisions, not dozens of average ones. This is a very important principle. And basically, in the investment field, you have two categories. People that like diversification, people that like concentration. This is it, diversification, concentration. I'm on the concentration camp. I know that you can make money in two ways, but this is how I have invested so far. And I believe concentration is a more simple way to outperform the market if you know what you are doing. If you know what you're doing, you know how to analyze companies, you have a framework, you can study them, you have a clear checklist, you know exactly what the growth opportunities are, what the risks are. So why would you diversify your holdings? Just for the sake of reducing your risk? Okay, fair enough. In this case, This is how I built my portfolio. I have between 10 and 15 companies. Many studies have found that after 15 companies, diversification is not that helpful. So actually, having 10, 15 companies is a great way to be diversified. You don't have 3 stocks, right? You have 10 companies. Let's say you have 10 companies. You are diversified enough, but you can still concentrate on your best ideas. This is exactly what I have been doing for the past decade. I have not diversified one bit. 10 companies, more or less. This is how I like to do it. And to be honest with you, I don't find many good opportunities. Even you watching this video, you may think, I don't find many opportunities right now. So how can I diversify if I don't find many interesting stocks, interesting companies? Now we are living in an environment where you don't find many companies to invest. So diversification is a very hard thing to do because you have to find many companies. Concentrated in your portfolio allows you to have this mental flexibility, I would say. You know you don't have a lot of opportunities, so you just focus and you swing big. You invest in a sizable percentage of your portfolio, I would say. And if you pick right, if you know what you're doing, if you pick great companies, well, if you have a portfolio allocation that is very high, if you have a concentrated portfolio, it will increase your performance. Obviously, if you make a position 20% of your portfolio, if this stock doubles, you will make a lot of gains. Okay? In the opposite situation, if you have a diversified portfolio and this stock is 2% of your portfolio, if it doubles, it will make no difference. No difference. Actually, no difference at all. And we, as retail investors, have the luxury of being flexible. We can have a portfolio that is very concentrated. We can have a portfolio with uninvestable stocks, with companies that hedge funds can't touch, that investment funds can't touch because they have a mandate to be diversified, to be invested in ESG, to avoid oil and gas companies, for example. I have worked in an ESG fund before. I know how it is to have mandates, and whether you want or not, you have boundaries. So that can totally work. Anything is possible. But we have the flexibility as retail investors to be free to do whatever we want. You can invest in 3 stocks if you want. You can invest in an oil and gas play, a tobacco play. Everything is possible, right? So take advantage of this luxury, right? We have the flexibility. Why would you like to diversify and invest in normal companies when you can invest in niche companies that nobody understands, that you can believe in? You have done the work, you can put 20% of your portfolio. I have generated a big alpha thanks to TPL, Texas Pacific Land. At the time, very few investment funds were invested in TPL because TPL, Texas Pacific Land, was very small, $4 billion of market cap, and it was a link to the oil and gas market. So that removes all of the mandates from our hedge funds. It was a small cap misunderstood. Okay, small cap, mid cap misunderstood. Now that TPL is having a valuation of more than $20 billion, people start to see the value in the company. People start to see the business model, how it does. It's big enough so investment funds can invest in it. And as retail investors, we have the flexibility to spot them before the big money starts coming in, before the institutional funds start buying in. So you have a buying pressure, and this is perfect exit liquidity, but this is for another video. I made almost a 10x on TPL. Before it was sexy, before people talked about it. You had 0 YouTube videos about it, 0 people on Twitter talking about it, very few blogs that were mentioning TPL, very few articles. We have the luxury as retail investors to do this. And this is how I built an Unbreakable portfolio. I just spotted ideas before everybody else because I'm free to do whatever I want. And you can concentrate, create a concentrated portfolio with the best ideas. Principle number 4, stay calm when others panic. Very important, but a great reminder. Market declines aren't threats, they are opportunities for the prepared. This is a great advice that I wish I implemented sooner. Because yes, you can read as many books as you want about staying calm, long-term holding, but very few people apply this principle. You can look at what happened in April 2025, a few months ago. Market panic, market drawdown of 20%. Trump was scary, the situation was messy, you had a lot of tariff threats. It was the perfect kind of correction you could wish for, actually. It was a self-inflicted market correction and easily fixable. So actually, this market decline was a gift. And at the time, a lot of people were panicking. As a long-term investor, I've been in this field for many years now. You will have the markets that will go up massively, go down massively. It will happen. When you are ready that anything can happen, you don't panic. I didn't panic at all. I did not panic sold at all during April. This is the reason I have been outperforming the market for the past decade. And for 2025, I'm again outperforming the market. This is the reason I'm beating 90% of investors. Having the temperament of knowing what you own, right? And being calm when other people panic. And actually, another tip, we've seen this in March 2020. Sometimes when you have market declines, funds become forced sellers of stocks because of a mandate, because of liquidity, because of redemptions, etc. Sometimes funds are forced to sell a stock, even though the stock is cheap. This is great to be on the other side of the bet, to buy excessively cheap shares of companies that are trading at a very low valuation. You will get crazy things, funny things happening in the market. And if you can spot these opportunities and seize these opportunities, you will outperform the market. If you have a clear framework, a clear understanding of what the company does, the stock, etc., you will outperform the market. This is also what I've been teaching my students inside the coaching program. This is what I've been doing with them. We've worked on them for a couple of months now. I see the difference. No panic. They know what they do now. They know what they own, and they have built confidence to create their dream portfolio. If this is you, you know what to do. You have the first link in the description. So that was the principle number 4, stay calm when others panic. And am I done? Yes, I'm done with that. So the key principles for this video are very simple. You invest in what you understand. You only focus on good companies that are strong with a lot of cash, that are not hype, that will fade away with a lot of debt. You concentrate on your best ideas and you stay calm. This is exactly the clear framework I've been using for the past decade, and that has averaged around 25% per year.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.